Assalamu alaikum wa rahmatullahi wa barakatuhu. This is a new slideshow and relating to partnership accounting, and in this slideshow one question is covered, and in this question we are going to learn how to prepare appropriation account, current account and calculate stock turnover. This question is very good for O-level accounts and for grade 11 and BCom students. Now we go to the question, real question. This is the question. Over here below given relates to, below information relates to Bell and Hayward partnership. There are two partners. Capital accounts for both of the partners is given below on May 1, 2008. Current account balances are also given over here. May 1, 2008, Hayward has a debit balance of 1500. Drawings for the year ended April 30 is also given over here, 6000 and 20,000. The partnership agreement includes the following terms. Interest on capital per year is 6%. Hayward has a salary for $12,000. Interest on drawings is charged 4% per year, and profit and loss is equally shared. Bell introduced $10,000 additional capital on August 1, 2008. Net profit is 20,500 for the year ended April 30, 2008. The requirement is state two differences between partnership and limited company. Prepare appropriation account for Bell and Hayward for the year ended April 30, 2009, and prepare current account for Hayward for the year ended April 30. Now to the second slide. This is the second part of the question. Bell and Hayward provided the following information. Opening stock is given as $17,000, closing stock is given as $15,000, purchases is $238,000 and sales is $300,000. What is required is to calculate stock turnover rate for the year ended 2009 and calculate gross profit percentage, gross profit to sales percentage. The figure for the previous year is also given so that we can compare the this year's performance with the last year for the previous year. And there is another requirement is suggest two possible reasons for the changes in the figures between April 30, 2008 and April 30, 2009. This concludes the question, and now in this next slide we are going to learn how to solve it. Partnership have unlimited liability. That means that partners may lose their personal belongings, even their house, to pay off the debts of the partnership. And companies have limited liability. Shareholders' liability is very limited to the extent to the amount they have invested in the company. If the company loses or closes, then the investment for the loss for the shareholders is limited to the amount they have invested in the company. Partners share profit earned during the year. Partners they keep on earning and sharing between themselves, whereas the shareholders for the shareholders they receive dividends, and sometimes they do not receive dividends, and sometimes because it depends upon the decision of the directors of the company. Now the P part of this question, net profit for the year is 20,500, and interest on drawings. Bell's drawing is 6%, and 4% for this is $240. and Harvard has $20,000 drawings, and 4% for that is $800. The total is 1,040, and if we add this is to be added up in the profit. That gives us a 21,540 as the total profit, and from this total profit the interest on capital is deducted, which is calculated below. Working for Bell is given in the working last slide as W1, and Harvard has a 20,000 capital, and for the whole year, that is 12%, 6%. As for 6%, it comes to 1200, and the total for interest on capital would be 4050. This is deducted from the total profits, and that comes to around 17,490. From this amount we have to deduct salary to Harvard, and that is 12,000, and we are left with profit of 5490. This amount 5490 is equally divided among the partners. Now we go to the next slide. Over here the Harvard current account is calculated. Opening balance is debit balance as 1500, and drawings were 20,000, and interest on drawings is $800. On the credit side, it has interest on capital as 1200, and salary he has received is as 12,000, and share of profit is 2750. And if we add up both of the debit and the credit, we are left with the debit balance of 6,355. Okay, now we calculate the rate of stock turnover. The formula is given below. Cost of goods sold is divided by average stock. Working kindly consult the last slide. 2,40,000. Cost of goods sold is 2,40,000 divided by 100, divided by 16,000 as the average stock, and that comes to around 15 times. And how to calculate gross profit on to sales percentage? Gross profit is divided with the sales and multiplied with 100 to get the percentage, and gross profit is 60,000 divided by 300,000 multiplied by 100, which gives us 20% as a share of gross profit to the sales. Means cost of goods sold was too high over here, otherwise the gross profit would have been slightly more. Okay, now go to the E part. Sales volume might have increased due to increased advertisement. Yes, sales is increased definitely because of the advertising, and gross profit percentage has gone down due to increased cost of goods sold, and cost of goods sold might be because of the higher purchases or higher cost of raw material or purchase cost, and therefore the sales did not increase accordingly. As much sales did not increase according to the advertisements. This is there is a probability. Now we go to the last slide on the workings. These are the workings, and we can calculate, or everything is calculated over here, worked over here. You can very easily conclude with this thing. With this conclusions, the partnership accounting is concluded, and on next term I am going to give you some other topic, and you are very kindly requested to please subscribe and share it with your friends. Thank you very much. Allah Hafiz.